Hello and welcome to CMS Forex Daily Video Recap. I'm your fundamental market analyst, Nick Nassad. Today is Wednesday, August 25th, 2010. Let's start by taking a look at the euro-dollar pair, where we saw it rallying overnight as it hit resistance level at 1.2730. We had mentioned this is a very important level that had been support last week and now has turned to resistance, and it did hold. And from there, the euro actually declined, though it stuck within the trading range we had seen yesterday, finding support of just above 1.26. And in New York trading, we see the euro moving back up again. So we're sort of in sideways trading following yesterday's session, but it was important to see this resistance hold, so that should be a bearish signal for this pair, depending on how things go the rest of the week. The move higher in the euro overnight coincided with a better than expected Germany IFO Business Climate Index, which advanced to 106.7 for August from 106.2 in July, which was higher than the forecast figure, which actually had predicted a slight decrease. Current conditions led the rise as that index rose to 108.2, while expectations dipped a little bit. But it's no secret that Germany is doing pretty well right now. The second quarter, the GDP rose at a record pace of 2.2% as companies ramped up production in order to fill booming export orders. However, it's the rest of the Eurozone countries, especially the southern tier, that have analysts worried about the rest of the year in terms of Eurozone growth. If we take a look at the US dollar Japanese yen pair, yesterday we had very sharp moves in all of our yen pairs, with the moves in favor of the yen. But as we can see, we retraced a good part of those moves in overnight trading. Here we reached the 84.66 level, though then the yen advanced again. But as we began New York trading, and as we film this video around 10 a.m. Eastern, we do see the dollar winning back even those late losses as well. We came into this week with chatter about Bank of Japan intervention being underwhelming, and so traders may have been testing the resolve of government officials, and we saw this very sharp move. But now with this sharp move, we may see an increase of the willingness of government officials to actually intervene in markets, so we'll see how that continues to play out the rest of the week. Now, overnight in the Asian session, we did have Japan's trade balance for the month of July come out, and on the face of it, it was better than expected, as the non-seasonally adjusted trade balance rose to 804 billion yen, while the seasonally adjusted trade balance rose to 610 billion yen, both better than expectations. While exports advanced 23.5% on the year in July, this was less than June's 27.7% gain, and it's the fifth consecutive month that the pace of growth has slowed. Imports, meanwhile, climbed 15.7% in July from a year earlier compared to a 26.1% gain in June, and that was the main reason for the trade balance actually rising. So it wasn't that we had an increase in exports, but more a decrease in imports, which led to the better than expected trade balance figure. Now, another safe haven currency, the Swiss franc, gained in today's trading following its move stronger against the dollar in late yesterday trading, especially after we had the weak existing home sales release from the US. Now, I hadn't mentioned this currency in yesterday's video, but in a battle between the three safe havens, the yen, the US dollar, and the franc, it seems that the US dollar may be losing out as its economy's performance hurts the currency's value. If we look at the Euro-Swiss franc pair, here too we see the franc gaining, especially yesterday, and then it kept those gains from yesterday's session and advanced further to the 1.2978 level. We had consolidated last week between 1.3260 and the 1.3450 level, but we broke below that late last week and extend those gains now in favor of the Swiss franc in this week's trading. We have seen this pair slide very sharply throughout the last few weeks in August, as we had been at the 1.39 level just on August 11th, and now we're all the way down to the 1.2980 level, almost a change of 1,000 pips. Now that cuts all of the gains that the euro had seen throughout this period in July and early August, and it also equals the swing we had seen here throughout June, which was also amounted to about 1,000 pips. It was around here in the middle of June at around the 1.3750 level that we did have the Swiss National Bank say that they would stop their intervention and to try to keep their currency from continuing to appreciate. Following that announcement, we saw the Swiss franc gain very sharply until we hit this low on June 30th around 1.3080. From there, we saw the euro rally as it did generally against most of its counterparts. But again, we see now a move back in favor of the Swiss franc as risk aversion takes hold more generally in the currency markets. So here too, similar to what we see with the yen, is a question of testing the Swiss National Bank's resolve in order to see if it will continue to let its currency appreciate. Of course, that would mean that the competitiveness of Swiss exports, like expensive Swiss watches, will erode. So here too, it's important to look out for any news about the SNB and what they think about the currency moving below its lows from early July. In a look at one of our commodity currency pairs, US dollar, Canadian dollar, here we see it bouncing between two levels that we had outlined at the beginning of the week, 1.0570 and 1.0670. So that was the range we had been in the second half of yesterday's trading. And we see that the greenback gained around the beginning of the US session as we had some weak releases from the US, which may imply risk aversion. We also did have US stocks opening lower, but we didn't really push above where we were in yesterday's session. In the Aussie US dollar, however, we see a rather strong move in favor of the greenback as we break below the 0.8850 level, which I have mentioned is very important as it had acted as resistance earlier in July. Then it broke as resistance and had acted as support twice in the last few weeks, but we did have this downward sloping resistance trend line forming a descending triangle pattern, and it looks like we finally are breaking that support level. And so if we hold below this level, that opens up the pair to further losses, with the next support level coming at around the 0.8630 level. So this, of course, in the last few weeks, we have seen the theme of risk aversion and slower global growth taking hold, and so that is hurting our commodity currencies linked to global growth outlooks. Now, we did have two releases from the US, both coming in under expectations. First up, durable goods orders rose by 0.3% in July, much weaker than the 3% expected. If we took out transportation orders, which were up 13.1% out of the equation, so durable goods excluding transport, we actually fell 3.8%, again, far below expectations and a very weak reading. The jump in transportation orders was actually due to a spike in civilian aircraft orders. In the third measure from the release, non-defense capital goods orders excluding aircraft, which is a very good measure of capital or business investment, fell 8% on the month following a 3.6% jump the month before. So all in all, this is a very poor report on the state of durable goods orders, which are those goods designed to last longer than 3 years, such as cars or appliances. And in our second release, we saw new home sales for the month of June decrease by 12.4% from the previous month to a seasonally adjusted annual rate of 276,000. That was below expectations, and that figure is the lowest level of sales on record going back to 1963. Inventories increased, so this is just another signal that the housing market in the U.S. will continue to struggle without support from the government's first-time home buyers tax credit, and another drag on U.S. growth overall. So we'll see how these reports affect stocks in the US throughout the day. It's still early in the morning in the New York session, but stocks are down to open the day. If we take a look at the upcoming fundamental docket, tonight Australia posts two releases, a measure of leading index, as well as private capital expenditure. Overnight, Germany releases a measure of consumer confidence. Switzerland releases its employment level for the second quarter. The Eurozone posts M3 money supply and private loans data, and the UK releases a measure of retail sales. Tomorrow in the US, it's a light day with just the weekly jobless claims report. Also, we'll have day one of the Jackson Hole Symposium in the U.S., which is attended by central bankers, finance ministers, academics, and financial market participants from around the world. Since those participants do talk with reporters, some of their comments can cause market volatility. And that will wrap up today's video recap. For more news, videos, and analysis, please visit our site, cmsfx.com. I want to thank you for watching and wish you good trading.